Now, as we explained, the Reserve Bank today raised interest rates by 0.25% to 2.85%. Rates have now been raised by 2.75% since May, making this one of the most rapid rate rise cycles in history. But the Reserve Bank isn't done yet. In his statement, Governor Philip Lowe says there will be more rate rises ahead. The board remains resolute in its determination to return inflation to target and will do what is necessary to achieve that, he said. So let's hear from the Treasurer, Jim Chalmers, and Shadow Treasurer, Angus Taylor, in response to the RBA's move.
Well, I think Australians already know that the costs of living are high and getting higher, and the Reserve Bank's new forecast for inflation reflects that. Whether it's the Reserve Bank or the Treasury, the expectation has been for some time that the peak won't happen until later in the year. That is especially so when you consider increases in energy prices brought about by the war in Ukraine, combined with the price of food going up as a consequence of the flooding of some of our best farmland in Australia.
I tell you who hasn't done enough, and that's Jim Chalmers. I mean, to be in a position where we've got rising inflation and interest rates, and that he hasn't even got a plan to get back to budget balance. He's given up the ghost. I mean, he's put up the white flag here on having a balanced budget. Now, if you want to take pressure off interest rates and inflation, any economist will tell you, balance your budget. If governments don't balance their budget, then small businesses and households will have to. If governments don't balance their budgets, small businesses and households will have to take the pain.
So just how many more rate rises will the RBA be forced to make to quell that inflation? Paul Bloxham is the Chief Economist with HSBC in Australia and New Zealand, also a former economist with the Reserve Bank. Paul, always good to chat to you. Does this decision change anything, in your opinion, about future RBA rate moves?
Well, this decision doesn't. No, I think this decision was as we expected. The RBA had already pivoted to smaller rate rises last month in early October. So the 25 basis point move they did then, and this decision, I guess the debate was about whether they might go 50 because they had an upside surprise to the CPI numbers last week, or whether they would once again just stick on the pathway that they'd set themselves and go by 25. And that's what we saw in the end. That's what we expected to happen. I think the RBA, although the statement obviously flags that they are still very concerned about high inflation, it does start to point out all the different things that are going on in the other direction. They're worried about global growth. That's likely to be disinflationary in terms of the global growth downturn that's going on. We've got the labour market, which is starting to lose a little bit of momentum. Yes, it's very tight, but employment growth has been flat for the past 3 months, and so there's some signs there that things are slowing. And then, of course, the fact that they've already lifted the policy rate, as you say, by 275 basis points in this cycle very, very rapidly, and we're yet to see the full effect of it. We're going to see it feed through to more house price weakness and more of a decline more of a slowdown in consumer spending, as of course we get all those mortgage resets from those fixed rates, the variables and so on. So I think my sense is the RBA, although I think they will lift interest rates further, they're much, much closer to the end of this hiking cycle than we are to the beginning. I don't think there's a whole lot more to come from the RBA. One more hike in December, and then when we get to the early part of next year, our expectation is by February, when they meet next time, a lot of those other downsides will have played out. The global economy will have slowed, local economy and inflation will have peaked as well. The labour market may very well be softening by then.
So you're saying 3.1%, the Christmas period becomes at a very opportune time for the Reserve Bank. It gets a month off in January, and unlike other central banks, it does meet otherwise every month of the year. So it really does get plenty of opportunities to have a go. So it can tweak if it needs to. It can take a rest for a while and just see it all flow through. But of course, it depends on the urgency and I guess the next print of inflation when they start to come through.
That's right, that's true, and certainly the inflation numbers are something we need to watch really carefully. And I might add, by the way, we've of course got a monthly indicator now that the Bureau of Statistics is publishing, so we won't necessarily be entirely beholden to waiting to those quarterly prints. We'll actually get a print at the end of each month ahead of the RBA meeting, and that'll be helpful. But my view is that actually, in some ways, to work out the RBA's next move, the pathway for the cash rate and when they might decide to pause, we're now going to start focusing more on the labour market. The inflation numbers are high, they are, but they are likely to be near their peak and they will come down. And for me, then the next thing that will make the RBA sort of decide that it doesn't need to lift interest rates further is once we see the unemployment rate start to lift, once that's troughed, once the unemployment rate rises. And if you think about it a little bit more, they've lifted interest rates a lot. The housing market is cooling. The economy will slow down as a consequence of that, in our view. The global economy is slowing down, and that'll have a reverberating effect through the domestic labour market as well. And then on the other side of the equation, well, the border is reopened. We are starting to see a flow in of workers from offshore. So by the time we land in the early part of next year, our view is the labour market will have lost momentum. It will be softening up. The unemployment rate will be starting to rise. And at that point, we think the RBA will pause because we don't think they'll want to be lifting interest rates if the unemployment rate is on an upward trajectory. Even if inflation is high, as long as it's heading in the right direction, they might be satisfied to sit still.
Just one issue there, though, is the consumer and consumer behaviour. We talked about house prices, and there's a lot of build-up of savings and equity in people's homes over the past couple of years. Now, the Reserve Bank today, and this comes off the back of retail sales, continuing to be strong, 9 months of record retail sales. It says today, effectively, that strong domestic demand relative to the ability of the economy to meet that demand is also playing a role. Returning inflation to target requires a more sustainable balance between demand and supply. So in many ways, this also comes down to consumer spending and the consumer's resilience to absorb these rate rises.
That's right. And so far, you're right. We've seen not that much evidence that the consumer's pulling back. But I might point out that the retail numbers we got earlier this week, yesterday, were a little on the softer side, because you've got to keep in mind all these retail figures we're keeping track of, the ones that are published, are nominal figures. They include the price impact as well. Inflation's running at a decent clip. Actually, in New South Wales and Victoria, it would be reasonable to think that retail volumes have really started to stagnate, started to slow down. There are telltale signs that the interest rate rises we've seen are starting to feed through to both, obviously, a cooling housing market. House prices are down nationally by 6.5%, 7%. But also, in addition to a cooling housing market, that they are starting to impinge upon the consumer to a degree. And it's early days. That's the point. They've just lifted interest rates really aggressively, really rapidly, and just recently. So over the next few months, I think we will see more clearer signs that the consumer is pulling back. And by the time we get to the early part of next year, that will be something that plays into the RBA's decision-making, I think.
Paul Bloxham, always great to have you on the program. Many thanks for your input today on an important day for the Reserve Bank.
Thank you.